Something has quietly shifted in Florida's housing market, and the numbers are no longer subtle. Condo prices across the state have fallen nearly 10% year over year, marking the sharpest drop since the last housing crash, and it's happening faster than most homeowners realize. Entire markets that were exploding just 2 years ago are now freezing, with listings sitting unsold, price cuts stacking up, and sellers pulling homes off the market in frustration. Florida now dominates the list of America's fastest cooling housing markets, not by a small margin, but overwhelmingly. This isn't a single city slipping. It's a statewide pattern forming at the same time. Insurance costs are surging, buyer demand is vanishing, and ownership is becoming harder to sustain every month. The most dangerous part? This is exactly how housing downturns begin quietly, unevenly, and then all at once. That sudden shift didn't come out of nowhere, it came from the numbers quietly changing beneath the surface. While prices were still near record highs, buyer behavior had already started to break. Showings slowed, offers disappeared, and inventory began stacking up in markets that were supposed to be untouchable. What makes Florida different right now is scale. This isn't one overheated city correcting itself. Florida has become the center of America's housing slowdown. More Florida metro areas are cooling faster than almost anywhere else in the country, and they're doing it at the same time. When demand weakens statewide while supply keeps rising, it creates a pressure imbalance that markets can't hide for long. The warning signs aren't coming from headlines. They're coming from the data patterns that appear right before housing momentum snaps. The first place this pressure finally broke was the condo market, and the data here is impossible to ignore. Across Florida, condo prices are now down roughly 8–10% year over year, the largest decline since the 2008–09 housing crash. In cities like Cape Coral, Tampa, Sarasota, and parts of South Florida, condo values have fallen faster than single-family homes, even as sellers flood the market with new listings. Inventory in some condo-heavy metros has jumped 30–50% compared to last year, while sales volumes are down double digits, meaning more units are chasing fewer buyers. At the same time, HOA fees have surged 20–40%, insurance premiums in coastal buildings have doubled or tripled, and special assessments are hitting owners with sudden $10,000, $50,000 bills. That combination turns condos from affordable entry homes into financial traps almost overnight. Historically, this is how Florida downturns unfold. Condos crack first under rising costs and falling demand, and once that domino falls, pressure spreads outward to the rest of the housing market. Once condos began slipping, the next signal followed fast. Inventory started piling up, and buyers quietly stepped back. Across Florida, active listings are now up 30–60% compared to last year, depending on the metro, while closed sales are down 15–25%. That gap is critical. Homes aren't just taking longer to sell, many aren't selling at all. Days on market have stretched from just a few weeks during the boom to 2, 3, even 4 months in some areas. And instead of aggressively cutting prices, many sellers are doing something far more telling. They're pulling listings entirely. Nationwide, delistings are up roughly 40–45%, and Florida is one of the biggest contributors. This behavior usually appears when sellers realize the market won't meet their expectations anymore. When supply keeps rising, demand weakens, and sellers refuse to accept new prices, pressure doesn't disappear, it builds. And historically, this is the phase where housing slowdowns stop being temporary and start becoming structural. This is where Florida's housing slowdown turns dangerous because, unlike past cycles, prices aren't the only problem anymore. Insurance costs across the state have exploded. In many coastal and storm-exposed areas, homeowners' insurance premiums have doubled or even tripled in just 2 to 3 years. A policy that once cost $2,000, $3,000 a year is now coming in at $6,000, $8,000 or more, and in some cases, coverage isn't available at all. Add rising property taxes, sharply higher HOA fees, and new special assessments, and the monthly cost of owning hasn't just increased, it's repriced itself entirely. In several Florida metros, housing costs are now consuming 40–50% of median household income, far above sustainable levels. This is why buyers are hesitating and sellers are getting trapped. Even if prices fall, ownership costs keep rising, and that creates a market where affordability doesn't recover, demand stays weak, and pressure keeps building beneath the surface. At this stage, the language around Florida's housing market starts to change, and that's never a coincidence. Some analysts still call this a correction, pointing to the massive run-up during the pandemic years. But others are warning that Florida is slipping into something more dangerous because the fundamentals are no longer improving. Price forecasts for several Florida metros now show flat to negative growth through 2025 and into 2026, with projected declines of 2–5% in the weakest areas. That may sound small until you combine it with rising inventory, falling sales, and ownership costs that continue to climb even as values drop. Historically, true crashes aren't defined by one massive price collapse up front. They begin with denial, split opinions, and gradual declines that drain confidence. That's the phase Florida is entering now, where the market doesn't collapse overnight, but steadily loses buyers, liquidity, and momentum at the same time. And once confidence breaks, prices tend to follow faster than expected. This pressure isn't spread evenly, it's concentrating in specific Florida markets, and that's what makes the risk easier to see now. Southwest Florida has become one of the weakest zones in the state. Cities like Cape Coral and Fort Myers are seeing price declines accelerate as inventory surges 50% or more year over year, while sales activity continues to fall. Tampa and Sarasota are showing a similar pattern: rising listings, longer days on market, and condo-heavy neighborhoods slipping first. Even parts of South Florida, once insulated by international demand, are starting to crack as affordability collapses and insurance costs push buyers away. The common thread across these cities is exposure, high investor ownership, heavy condo concentration, and ownership costs rising faster than incomes. Historically, downturns don't hit everywhere at once. They spread from the most vulnerable markets outward. And right now, these Florida cities are acting like early warning beacons for what happens when demand retreats, but supply keeps coming. If these pressures don't ease, the next phase is usually where downturns accelerate. As listings sit longer and price cuts stack up, investors are the first to exit, especially in condo-heavy markets where carrying costs are rising every month. That adds more supply at the worst possible time. With mortgage rates still elevated and insurance costs climbing, buyer qualification tightens further, shrinking the pool of people who can even close a deal. Historically, when inventory remains high for multiple quarters and sales stay weak, prices don't just drift lower, they reset. Analysts are already modeling scenarios where weaker Florida metros see additional 5–10% declines if inventory stays elevated into the next selling season. Forced sellers begin to appear, confidence erodes, and the market's psychology flips from wait for higher prices to sell before it gets worse. That's how slowdowns turn into self-reinforcing cycles, without a single dramatic headline but with real consequences for homeowners and local economies. Florida's housing market doesn't need a sudden crash to cause real damage. The warning signs are already doing that job. Prices are slipping, inventory is swelling, buyers are retreating, and ownership costs are climbing faster than incomes. Condos cracked first, demand weakened next, and now entire metros are feeling the strain at the same time. This still isn't 2008, but markets don't repeat, they rhyme. Every major downturn begins with denial, then normalization, and only later panic. Florida is now past the denial phase. The danger ahead isn't a single dramatic collapse, but a drawn-out grind where affordability never returns. Sellers lose leverage and values quietly reset lower. For homeowners, buyers, and investors, the window to act isn't months or years away, it's closing right now.